Have you ever walked into your bank expecting to withdraw your own money, only to be told you couldn't access a single dollar? Imagine spending decades building your retirement savings, carefully planning for emergencies, and believing your money would always be there when you needed it most. Then one morning, your debit card stops working, your online banking is suddenly restricted, your withdrawal request is delayed, and no one at the local branch can immediately tell you when you'll get access again. It sounds unbelievable, but situations like these have happened to Americans for a variety of reasons, including fraud investigations, identity verification issues, suspicious transaction alerts, and legal account holds. If you're over 65, understanding how these systems work has never been more important, because today's banks use sophisticated fraud detection technology that can react within seconds, sometimes before you even realize there's a problem. And while those systems are designed to protect customers, they don't always get it right. Today, I'm going to show you 7 situations that can increase the chances of your account being temporarily restricted or reviewed. And more importantly, the practical steps you can take to reduce that risk. One of these situations surprises even financially responsible retirees. So make sure you stay with me until the end, because the final protection strategy could save you days or even weeks of stress if your account is ever flagged. Welcome back to Robert Preston. If this is your first time here, this channel is dedicated to helping America's seniors stay informed about retirement, Social Security, Medicare, taxes, banking, and the financial changes that can affect your everyday life. Our goal isn't to create fear, it's to give you reliable information before small problems become expensive ones. If that sounds helpful, consider subscribing so you never miss an important update. Now, let's begin. Why this matters more than ever. Over the last several years, financial scams targeting older Americans have grown at an alarming rate. Every year, criminals steal billions of dollars from seniors through phone scams, fake government calls, romance scams, investment fraud, tech support scams, and identity theft. Banks have responded by investing heavily in fraud prevention. Today, many financial institutions rely on advanced computer systems that constantly monitor account activity. These systems analyze spending habits, login locations, devices, transaction history, and unusual account behavior. Their goal is simple: protect customers before money is lost. Most of the time, these systems work remarkably well. They stop stolen debit cards, they detect hacked accounts, they prevent fraudulent wire transfers. But sometimes, the system sees something unusual that is completely legitimate. And when that happens, an honest customer can suddenly find themselves answering questions they never expected. That's why understanding how banks identify unusual activity is so valuable, especially during retirement, when many people depend on timely access to Social Security benefits, pension payments, or retirement savings. The truth about account freezes. Let's clear up one common misunderstanding right away. Banks do not freeze accounts simply because someone turns 65. Age alone isn't the reason. However, older adults are statistically more likely to be targeted by financial exploitation. Because of that, banks often pay closer attention when they detect unusual activity involving customers who may be considered vulnerable under certain policies or state laws. In addition, federal anti-money laundering rules and fraud prevention requirements apply to customers of every age. When suspicious activity appears, banks sometimes place temporary holds while they verify that transactions are legitimate. That can feel frustrating, especially when it's your own money. But understanding what triggers those reviews can help you avoid many of them before they happen, and that's exactly what we're going to cover today. A story every retiree should hear. Let me share an example. Picture a retired couple. After years of saving, they decide to withdraw several $1,000s to pay for a major home repair after a storm damages part of their roof. The withdrawal is much larger than anything they've made in years. Within minutes, the bank's fraud system flags the transaction for additional review. The couple suddenly has to verify their identity and explain the purpose of the withdrawal before the funds are released. Was the bank accusing them of doing something wrong? No. The bank was trying to determine whether someone else was attempting to access their money. The review was temporary. But the delay created stress at exactly the wrong time. Stories like this remind us that understanding how modern banking systems work isn't just useful, it's becoming an essential part of protecting your retirement. Trigger number 1. Large, unexpected withdrawals. Have you ever noticed that when you do the same thing repeatedly, it becomes your routine? The same principle applies to your bank account. Modern banks don't simply record your deposits and withdrawals anymore. Many financial institutions use sophisticated fraud monitoring systems that learn what your normal banking activity looks like over time. For example, maybe you usually withdraw between $100 and $400 at a time. Perhaps you pay your utility bills online each month. Maybe your Social Security payment arrives on the third Wednesday and your spending pattern rarely changes. After months or even years, your account develops what banks often call a normal activity profile. Now imagine something changes overnight. Instead of withdrawing $300, you suddenly request $8,000 in cash, or you ask to transfer $15,000 to another account you've never used before. To you, the reason is completely legitimate. Maybe you're helping a family member purchase their first home. Maybe you're replacing a roof after storm damage. Maybe you're paying for a major medical procedure. But to an automated fraud system, it simply looks different from your normal behavior. And whenever something appears dramatically different, additional verification may be required before the transaction is completed. Again, that doesn't mean you've done anything wrong. It simply means the bank wants to make sure someone isn't forcing you to make the transaction or that a scammer hasn't gained access to your account. Why seniors are frequently targeted. Unfortunately, criminals often pressure older adults into withdrawing large amounts of money. They may pretend to be a government agency, a grandchild needing emergency help, a bank investigator, a Medicare representative, a law enforcement officer. Their goal is usually the same: convince someone to move money quickly before anyone has time to question what's happening. Because these scams have become so common, banks sometimes become extra cautious when they see unusually large transactions that don't match a customer's history. While these reviews can be inconvenient, they're intended to prevent devastating financial losses. How to reduce the chance of delays. Fortunately, there's a simple habit that can make a big difference. If you know you'll need to withdraw or transfer a large amount of money, don't surprise your bank. Instead, call a few business days in advance. Let them know approximately when you'll visit, the amount you expect to withdraw. The general purpose of the transaction. You don't need to share every personal detail. Simply giving advance notice can help the bank understand that the activity is expected rather than unusual. Many retirees are surprised to learn that a short phone call ahead of time can make the entire process smoother. Think of it this way. Planned activity usually creates fewer questions than unexpected activity. Trigger number 2. Suddenly changing how you bank now. Let's move to the second trigger. And honestly, this one surprises almost everyone because it has nothing to do with how much money you spend. Instead, it has everything to do with how you access your account. Here's what I mean. Suppose you've used the same laptop for 8 years. You always log into your account from home, usually around 9 o'clock in the morning. Then one weekend, your grandson helps you buy a brand new smartphone. You install your banking app. You log in from the new device. A few days later, you're visiting family in another state and check your balance from a hotel. Everything you're doing is perfectly normal. But from the bank's perspective, several things changed almost at once. A new device, a new location, a different internet connection, different login behavior. Modern fraud detection systems are designed to notice these kinds of changes because hackers often access stolen accounts from unfamiliar devices and locations. Most of the time, the system simply asks you to complete additional identity verification. Sometimes, however, it may temporarily restrict certain transactions until it confirms that you, not someone else, are using the account. Other changes that can raise questions. Here are a few everyday situations that can also trigger additional verification. Logging in from a new phone or tablet, using mobile banking for the first time, accessing your account while traveling, sending money to someone you've never paid before, using a digital payment service for the first time. None of these actions are wrong. Millions of Americans do them every day. But when several changes happen together, they may cause a bank's fraud system to ask for extra confirmation. Charkur Das. How to stay one step ahead. Fortunately, preventing unnecessary delays is often easier than people think. Whenever you're planning a significant change in how you bank, take 2 minutes to notify your financial institution beforehand. For example, I'm traveling next week and may access my account from another state. Or, I just purchased a new phone and will begin using the banking app. That brief conversation helps create context before the system notices something different. It doesn't guarantee you'll never be asked to verify your identity, but it can make the process much smoother. And when it comes to protecting your retirement savings, a few minutes of preparation today can save hours or even days of frustration later. Trigger number 3, trying to stay under the limit. Now let's talk about one of the biggest banking myths in America. You've probably heard someone say something like this: don't withdraw more than $10,000 at once, or if you keep it under $10,000, the government won't notice. Many people genuinely believe this advice. The problem is, it's often misunderstood. Let's clear it up. Where the $10,000 number comes from. When a customer deposits or withdraws more than $10,000 in cash, banks are generally required under federal law to file what's known as a Currency Transaction Report, or CTR. This report is sent to the federal government as part of anti-money laundering regulations. Here's the important part. Filing a CTR does not automatically mean you've done anything wrong. Thousands of these reports are filed every single day for perfectly legal transactions: buying a vehicle, paying a contractor, purchasing equipment for a business, selling property, receiving insurance proceeds. For honest customers, a CTR is simply a routine reporting requirement. The mistake some people make. Unfortunately, some people hear about this reporting requirement and think, I'll just split the transaction into smaller amounts. For example, instead of withdrawing $12,000 once, they withdraw $6,000 today and another $6,000 tomorrow. Or they spread several withdrawals across multiple days because they believe they're avoiding paperwork. Here's why that's risky. If someone intentionally structures cash transactions to avoid federal reporting requirements, that behavior can raise serious legal concerns under federal law. Banks are trained to look for unusual patterns, not just large amounts. That's why it's always better to conduct legitimate transactions openly rather than trying to work around reporting rules. What should you do instead? If you legitimately need a large amount of cash, don't panic. Don't assume you've done something wrong. And don't try to divide the transaction simply because of something you heard online or from a neighbor. Instead, speak directly with your bank. Explain what the money is for. Complete the transaction normally. For most honest retirees, that's all that's required. Remember, transparency is usually your best protection. Trigger number 4. Forgetting about old accounts. Now let's move to another situation that surprises many retirees, and unlike the previous trigger, this one has nothing to do with fraud. It has everything to do with accounts people simply forget. Let me ask you something. Do you still have an old savings account from years ago? A certificate of deposit you haven't looked at in a long time? A checking account you opened after retiring? Maybe an account you kept after moving to another state? If so, you're certainly not alone. Millions of Americans have financial accounts they rarely think about, but leaving an account untouched for years can sometimes create unexpected problems. What happens to inactive accounts? Every state has laws dealing with what are commonly called dormant or inactive accounts. If an account has no owner activity for a long period, often several years, depending on state law, the financial institution may eventually classify it as abandoned property. If that happens, the money isn't kept by the bank. Instead, it may be transferred to the state's unclaimed property program until the rightful owner claims it. Many people are shocked to discover that they actually have forgotten money waiting for them. Every year, millions of dollars are successfully returned to their owners through these state programs. Why this happens more often than you think. Retirees are especially vulnerable because many people intentionally leave savings untouched. Maybe you opened an emergency fund years ago. Maybe you created a savings account for future medical expenses. Maybe you simply forgot the account existed after opening a new one. Life gets busy. Addresses change. Banks merge. Paper statements stop arriving. Years pass. Before you know it, you've completely forgotten about an account you worked hard to build. A simple annual habit. Fortunately, this problem is one of the easiest to prevent. Once each year, set aside 30 minutes to review every financial account you own. Ask yourself, is this account still active? Is my mailing address current? Have I logged in recently? Do I still recognize every account I have open? If appropriate, make a small owner-initiated transaction or simply confirm the account remains active according to your bank's policies. That one yearly review can help you stay organized and avoid unpleasant surprises later. Check for unclaimed property. If you're wondering whether you, or perhaps even a deceased family member, may have forgotten funds waiting somewhere, most states operate official unclaimed property programs where residents can search for their names free of charge. It only takes a few minutes, and every year countless Americans discover money they didn't even realize was missing. It's one of those simple financial checkups that's well worth your time. Trigger number 5. What happens when your account is flagged? Now let's talk about something that catches many retirees completely off guard. Most people assume that if their bank account is ever flagged, they'll simply walk into their local branch, speak with a manager, explain the situation, and everything will be fixed within a few minutes. Unfortunately, that's not always how today's banking system works. Modern banks have several departments working behind the scenes. The friendly teller at your neighborhood branch handles deposits, withdrawals, and everyday customer service. The branch manager oversees branch operations. But when an account is flagged for possible fraud, suspicious activity, or identity verification, the review is often handled by a completely different department, usually called the fraud department, risk department, or compliance team, and in many cases, the employees at your local branch cannot remove those restrictions themselves. Why this can be so frustrating? Imagine this situation. Your Social Security payment was deposited yesterday. Your pension payment arrived this morning. Your checking account shows plenty of money. But when you try to use your debit card, it doesn't work. You visit the bank. The teller politely explains that your account is under review. Naturally, you ask, when will it be fixed? The problem is, the person standing in front of you may not have that answer. They're waiting for another department to complete its review. That can be incredibly stressful, especially if you have bills due, prescription medications to purchase, or automatic payments scheduled over the next few days. Fortunately, there are steps you can take that may help move the process forward more efficiently. Ask the right questions instead of simply asking, "Why is my account frozen?" Try asking questions like, which department is reviewing my account? What information do you need from me? Is there anything I can provide to help verify this transaction? Approximately how long should I expect this review to take? These questions often lead to much more useful conversations. Remember, the faster the bank can confirm that you're the legitimate account holder and that your transaction is genuine, the sooner the review can usually be completed. Stay calm during the process. One of the biggest mistakes customers make is becoming angry with the employee standing in front of them. It's understandable to feel frustrated. After all, it's your money. But the branch employee usually didn't create the hold. They're simply trying to help within the limits of their role. Remaining calm, providing requested documentation quickly, and responding promptly to verification requests often helps resolve situations more efficiently. Trigger number 6. Moving money to a new bank. Let's move to another situation that surprises many retirees. Suppose you've decided your current bank isn't offering competitive interest rates anymore, or maybe you found a credit union closer to home. Perhaps your financial advisor recommends opening an account at another institution. Everything sounds straightforward. You open your new account. Then you decide to transfer a significant amount of money from your old bank. Seems simple, right? Usually it is, but under certain circumstances. Large transfers to newly opened accounts may receive additional scrutiny from fraud monitoring systems. Why banks pay attention? Think about it from the bank's perspective. One of the most common tactics used by financial criminals is moving stolen money quickly through newly opened accounts. Because of that, banks often pay close attention when several factors happen together. For example, the destination account is brand new. The transfer amount is much larger than your normal activity. The receiving bank has never received money from you before. The transfer is initiated shortly after opening the new account. Again, none of these things mean you've done anything wrong, but together, they can cause the transaction to be reviewed before it's completed. A smarter way to move your money. If you're planning to transfer retirement savings to another financial institution, consider taking a gradual approach. For example, start with a smaller transfer first. Once both accounts have successfully exchanged funds, future transfers may appear more consistent with your normal banking history. You can also notify both financial institutions ahead of time. Let them know, I'm transferring funds between my own accounts. That simple conversation helps provide valuable context if the transaction is reviewed. Keep good records. Whenever you're moving a significant amount of money, keep copies of transfer confirmations, account statements, emails from the bank, wire confirmations, deposit receipts. Having organized records makes it much easier to answer questions if the bank requests additional verification. It also gives you peace of mind knowing you can quickly document exactly where the money came from and where it's going. One more important reminder: whether you're making a large withdrawal, traveling, changing banks, or opening new accounts, the goal isn't to avoid your bank's security systems. The goal is to make sure those systems recognize that you are the person making the decision. Communication is often one of the simplest and most effective ways to prevent unnecessary delays. A quick phone call today can save days of frustration tomorrow. Trigger number 7, making changes to a joint bank account. Now let's talk about the final trigger, and unlike some of the others, this one often happens during one of the most emotional periods of a person's life. Imagine this: after 40 years of marriage, your spouse passes away. Over the next several weeks, you're handling funeral arrangements, meeting with family members, updating legal documents, and trying to adjust to an entirely new chapter of life. Among all those responsibilities, you also need to update your bank accounts. Perhaps you need to remove your late spouse's name from a joint checking account. Maybe you're closing an old account and opening a new one. Or perhaps you're removing another joint account holder after a divorce or major family change. These are completely normal life events. But from the perspective of a fraud monitoring system, a sudden ownership change on an account can sometimes trigger additional verification. Why? Because financial exploitation often occurs after major life events. Scammers sometimes attempt to take advantage of widows, widowers, or older adults experiencing difficult circumstances. As a result, banks may carefully review ownership changes before processing them. Again, this doesn't mean you've done anything wrong. It's simply another example of modern fraud prevention systems trying to distinguish legitimate account changes from possible financial abuse. How to make the process easier if you're planning to make changes to a joint account. Bring any documents the bank may need. Depending on the situation, that could include a government-issued photo ID, a death certificate, legal paperwork, court documents, estate paperwork. Having everything ready before your appointment can make the process much smoother. If you're unsure what's required, call the bank ahead of time. A 5-minute conversation could save you an unnecessary second trip. You've seen the risks. Now let's talk about protection. We've covered 7 situations that can lead to additional account reviews. Some involve unusual withdrawals, others involve travel, some involve changing banks, others involve updating account ownership. The important thing to remember is this: none of these situations automatically mean your account will be frozen. They simply represent circumstances where banks may ask additional questions before processing certain transactions. The good news? There are several practical habits that can dramatically reduce problems before they ever begin. Let's look at the first 2. Protection layer. Number 1. Add a trusted contact. This may be one of the most valuable features your bank offers. And surprisingly, many retirees have never heard of it. It's called a trusted contact. Now here's something important. A trusted contact is not a joint account owner. They cannot spend your money. They cannot withdraw your savings. They cannot make financial decisions for you. Instead, they're simply someone your bank can contact if it has concerns about possible fraud or financial exploitation. For example, let's say the bank notices an unusual transaction and can't immediately reach you. Rather than making assumptions, they may contact your trusted contact to help verify whether everything appears normal. That extra communication can sometimes make resolving questions much easier. Who should you choose? Choose someone you trust completely. It might be your spouse, an adult son or daughter, a close relative, a lifelong friend, another trusted individual who understands your financial situation. Before adding someone, have a conversation with them. Explain why you've chosen them. Make sure they're comfortable accepting that responsibility. Most banks can help you add a trusted contact in just a few minutes. It's one of the simplest financial safety measures available today. Protection layer number 2. Keep your bank informed. Think about this. Who knows your financial plans better? You or a computer system? Of course, you do. The problem is, computers only see numbers. They don't know why you're withdrawing money. They don't know you're traveling to visit grandchildren. They don't know you're buying a new car. They don't know you're moving retirement savings to another bank. Without context, even perfectly normal activity can appear unusual. That's why communication matters. Before major financial changes, consider contacting your bank if you're planning to. Make an unusually large withdrawal, transfer significant funds, travel outside your normal area. Begin using a new phone or banking device. Open a new account elsewhere. Receive a large expected deposit. Giving your bank advance notice doesn't guarantee you'll avoid every verification request, but it provides valuable context before the transaction occurs. Many retirees find that these brief conversations help reduce unnecessary confusion later. Build a relationship. Here's another piece of advice that financial professionals often recommend. Don't wait until there's a problem to get to know your bank. Visit occasionally, introduce yourself, ask questions, learn who the branch manager is. Establishing a relationship with the people who serve you can make future interactions much easier. While they can't bypass security procedures, having staff members who recognize you and understand your history often makes communication smoother when questions arise. Protection layer. Number 3. Have the right power of attorney in place. Let's talk about something that many people don't think about until it's too late. Imagine you're recovering from surgery, or perhaps you've been hospitalized unexpectedly. Maybe you're simply unable to visit your bank for several weeks. Who can legally help manage your financial affairs? Many retirees immediately answer, "My son," or "My daughter." But here's the reality. Unless you've completed the proper legal documents, your family members may not automatically have the authority to act on your behalf. That's where a durable financial power of attorney can become incredibly important. A power of attorney, often called a POA, is a legal document that allows someone you choose to help manage financial matters if you're unable to do so yourself. However, not all power of attorney documents are exactly the same. Different states have different legal requirements, and some financial institutions have their own procedures for reviewing these documents before accepting them. That's why it's a good idea to discuss your plans with a qualified attorney if you're considering creating or updating a power of attorney. Once it's completed, ask your financial institution whether they'd like a copy on file. Taking care of that paperwork before an emergency happens can save your family significant stress later. Planning ahead isn't about expecting something bad to happen. It's about making sure the people you trust can help if life takes an unexpected turn. Protection layer number 4. Don't keep everything at one bank. Now here's a strategy that many financial professionals recommend. It's surprisingly simple. Don't keep every dollar at a single financial institution. Think about it this way. If your only checking account experiences a temporary fraud review, where will your automatic bill payments come from? How will you pay for groceries? What happens if you need prescription medication that same day? Having a second account at another bank or credit union can provide valuable flexibility. It doesn't need to contain your entire retirement savings. Many people simply keep enough money to cover several weeks of essential expenses. That way, if one account is temporarily unavailable while a question is resolved, you still have access to funds for everyday necessities. It's not about expecting problems. It's about preparing for unexpected situations. Just as many families keep an emergency savings fund, some retirees choose to maintain an emergency banking option as well. That extra layer of preparation can provide tremendous peace of mind. Protection layer number 5. Perform an annual financial checkup. Let's finish with one of the easiest and perhaps most valuable habits of all. Set aside just 30 minutes once every year. Treat it like your annual medical checkup. But instead of checking your health, you're checking your financial life. During that review, ask yourself a few simple questions. Are all of my bank accounts still active? Is my mailing address current? Is my phone number up to date? Have I reviewed my beneficiaries recently? Is my trusted contact information still accurate? Have I organized important financial documents where my family can find them if needed? Do I still remember every financial account I own? Small updates made once a year can prevent major headaches later. Think of it as routine maintenance. Just like changing the oil in your car helps prevent expensive repairs. Reviewing your financial information each year helps keep everything running smoothly. One final thought. If there's one message I hope you remember after watching today's video, it's this. Modern banks aren't trying to make life difficult for honest customers. They're trying to protect people from increasingly sophisticated financial crimes. Unfortunately, no automated system is perfect. Sometimes legitimate activity looks unusual. Sometimes extra verification is necessary. The good news is that preparation makes a tremendous difference. Simple habits, communicating with your bank, keeping your information updated, planning major transactions, reviewing your accounts regularly, and organizing important legal documents can help reduce confusion and make unexpected situations much easier to manage. Retirement should be about enjoying the life you've worked so hard to build. The more informed you are, the more confident you'll feel making financial decisions in an ever-changing world. Knowledge truly is one of your greatest financial protections. If you found today's video helpful, please take a moment to like this video. It helps YouTube share this information with more retirees and families who could benefit from it. And if you're new to Robert Preston, don't forget to subscribe and turn on the notification bell. Every week, we cover important updates affecting Social Security, Medicare, retirement planning, IRS changes, banking safety, financial scams, and practical tips to help America's seniors protect the money they've worked a lifetime to earn. Also, I'd love to hear from you. Have you ever experienced a bank asking for additional verification before completing a transaction? Or have you learned a banking lesson that other retirees should know? Share your experience in the comments below. Your story could help someone else avoid unnecessary stress. Finally, if you know a parent, grandparent, neighbor, or friend who's over 65, please share this video with them. One conversation today could help them better understand how modern banking systems work and encourage them to take a few simple steps to protect their finances. Thank you so much for spending your time with me today. Take care of yourself. Take care of your retirement. And I'll see you right here in the next video on Robert Preston.